In this week's video, we'll review the latest charts, taking into account the market's hot-button issues, including the yield curve, the Fed, and China. We'll kick off the video with some good news charts, and then we will talk about some bad news charts. This is the upward sloping trend channel that we talked about in detail last week. Chart dated November 30th, 2018. If we fast forward to the close on December 7th, 2018, price has remained in the upward sloping trend channel for now. So the good news charts are reasons to be patient, and the bad news charts will give us reasons to prepare for potentially lower lows in the coming days and weeks. Another S&P 500 daily chart as of the close on December 7th. You may remember we described these potential areas of support for the stock market in detail in a post on October 15th, 2018. You can find it by Googling this title here. For now, the market is holding near these two lines here. And some of those lines are based on retracements. Once again, the close on December 7th, 2018. U.S. election low here, A to B move. Price is hanging around the 38.2% retracement. If that gives way, the 50% and the 61.8% will give us reference points going forward. Similar situation. We had a pullback in 2017 here. The pullback low occurred in March. That would be our point A. The recent high would be our point B. Based on that move, we're holding near the 50% retracement level. If that doesn't hold, the 61.8% will give us another reference point. Once again, looking at the close, Friday, December 7th, we're still above all four of the 2018 lows that we've been using as additional reference points. And thus far, as of the close on December 7th, the S&P 500 has dropped just over 10% from the closing high made in September and the close on Friday, December 7th. You may have seen this tweet. It's information from Bloomberg. The white line shows the path of stocks during this correction, and the blue line is corrections that occurred in 2010, 2011, 2012, and 2015. Once again, providing some reference point for patience. Of course, that's all to be determined in the present day, but thus far, it looks very, very similar to these corrections. And while it feels horrible, we also know that a 10.15% drop, that's not a crash, that's a normal correction. In fact, we haven't even hit the median max intra-year drawdown from Charlie's table dating back to 1928. Now let's shift gears to things to be concerned about. This was a short takes post that was completed after the close on Monday, December 3rd. And on Monday, December 3rd, Monday of this week, the S&P 500 was up 30 points. You might expect a post after a 30-point rise that somewhat slants towards the bullish end of the spectrum. And if you read this post, that was not the case. Price action during the day really was not that impressive, and we knew that we had this gap down below that, at a minimum, would most likely be tested. Fast forward to Wednesday, December 5th, short takes post after the close. Tuesday's big drop increases the odds of the S&P 500 taking another significant leg down. Once again, on Tuesday of this week, we have price action, volume, breadth, other characteristics that are concerning. Thus, from a preparation perspective, especially from a psychological perspective, it might be helpful to have some type of historical reference relative to what a significant leg down might look like. Daily chart of the S&P 500 dated December 31st, 2007. We get what's known affectionately as a death cross here, where the 50-day moving average in blue crosses below the 200-day moving average. You can make an argument that this point A here looks very, very similar to the S&P 500 on December 7th, 2018, where we're getting a similar death cross. In some cases, when the market comes down and we have a chart pattern like this, the supporting evidence or the weight of the evidence, especially the short to intermediate term evidence, might give you some confidence that these levels would hold. And then there are other instances where the supporting data is saying we better be ready for the possibility that these lows will not hold. I think it's fair to say from a probability perspective, given what we know today and what's transpired in this area here, especially this week, we should be open to the case where the market takes out these lows. In this case, the market did take another significant leg down from this point A. So from a similar look here, number one, this prior low was taken out, and the additional loss from point A to point B, which occurred over basically 2.5 months, was 14.4%. And if you know your market history, you know that this 14.4% plunge eventually morphed into something much, much worse, which is why the week of Thanksgiving we covered the specific disciplined and logical exit strategy. Our current strategy takes into account the possibility that a look like this could morph into a look like this, and a look like this could morph into a look like this or this. And it's extremely important to note the following. When markets begin to fall, especially when they start to take another leg down, something that we refer to at CCM as press conference risk starts to increase. In the present day, if our point A that looks similar to this point here starts to morph into something like this, the odds increase that the Fed or the president via a tweet will step in some way, either a press release or having a Fed member go on TV or having the Wall Street Journal print an article, or it could be a tweet from the president where they try to flip the script, which is one of the reasons why we tend to step out in an incremental fashion. And there is an actual press conference taking place after the Fed statement that's going to be made on December 19th. Now, let's make some comparisons to this point B here. This chart here is dated March 17th, 2008. And let's compare it to the present day. But let's flip the charts here and look at the demand or conviction to own long-term Treasury bonds or TLT relative to SPY. This chart is also dated March 17th, 2008. So this is our point B here on the stock market chart where we dropped an additional 14%. And this back here is where the S&P 500 peaked in October of 2007. You can see before the S&P 500 peaks, we get a bullish cross with the 50-day crossing over the 200-day moving average in favor of bonds. And as the stock market drops, you can see the conviction to own defensive-oriented treasuries picks up considerably. How does the same chart look today? When the S&P 500 peaked in this case, blue is above red. When the S&P 500 peaks here in September, blue is well below red. The slope of red is down, and the slope of blue is down. From a fear perspective, this unequivocally looks a lot better than this over here. However, you can see the 200-day here is starting to flatten out. It's trying to turn up, and the 50 is turning up. So you can even see here the look of this chart on October 1st looks quite a bit better from a bullish perspective than it does today. If you own stocks, this is a more concerning look than this here, but it's still not nearly as concerning as the look at any time on this chart here. If this chart continues to morph into something that looks like this, our concerns would increase. And the message from the bond market still might be helpful, even if we make lower lows, relative to trying to understand what type of decline we may be facing. So now we're looking at our more traditional look with stocks relative to bonds. Year 2000, S&P 500 peaks here. We get a discernible lower high in the stock-bond ratio. Similar situation in 2007. In this case, we're using the ETFs, SPY and TLT. When the S&P 500 peaks, we have a discernible lower high, favoring bonds over stocks, favoring bonds over stocks. We already know from past videos we didn't have anything like that when the stock market peaked in September of this year. In fact, you can make an argument that these are bearish divergences with the stock market. The stock market makes a new high here, the ratio doesn't. The stock market makes a new high here, the ratio makes a discernible lower high. In this case, the ratio makes a discernible higher high after the stock market peaks in here. I would say that's the good news. The bad news is you can see that conviction is picking up to own treasuries relative to the S&P 500. This is also interesting. Notice the ratio of stocks to bonds makes its year-to-date low, in this case, after the stock market peaks, which makes sense. That tells us that demand or conviction for stocks is waning and hits a low for the year relative to bonds after the stock market peaks. Again, that makes sense. This is fear picking up. Similar situation here. Stock market peaks, fear increases or concerns about the future. The conviction to own growth-oriented stocks hits its year-to-date low on this chart after the S&P 500 peaks. Increasing fear, increasing fear. Present day really doesn't look anything like that. The year-to-date low in this ratio occurred on the first trading day of the year. And we can illustrate the concept by drawing a line from the left side of the chart to the low, left side of the chart to the low. In this case, the left side of the chart to the current low slopes up, down, down. None of this negates the concerns that we have in the short term, but all of it helps us keep an open mind that even if stocks fall quite a bit further in 2018, we most likely wouldn't be looking at something on the order of magnitude of 2007 or the year 2000. It's all to be determined. Let's talk a little bit about asset class behavior. And we're still on the section of the video that says things to be concerned about or bad news. 50-month moving average, technology versus healthcare, October 31st of this year, clearly favors tech. Tech versus healthcare, same date, October 31st. Now we're looking at our 30, 40, and 50-week generic and for illustrative purposes only moving averages. This isn't that concerning here. It still looks strong, favoring tech. And if we go down to the 200-day moving average on the same day, October 31st, 2018, the long-term trend still clearly favors tech over more defensive-oriented healthcare. As you might imagine, in this case, this is a very long-term trend. If we fast forward to the present day, there's not much deterioration. However, as we move to the shorter time frames, this not particularly concerning look on October 31st is starting to morph into something that is more concerning. And this chart does a good job summarizing shifts in asset class behavior that have taken place over the past several weeks and months. But now we're at a point where one of our leaders, or the market leader for the most part, is starting to show weakness relative to a defensive sector. This unequivocally looks more concerning than this. Similar situation and deterioration between October 31st and the present day, using tech versus healthcare and looking at the 200-day moving average. This is actually starting to turn back up here on October 31st. If we fast forward to December 7th, now we can see a discernible rollover look. This is a lower probability look, and this is unquestionably a higher probability look relative to this. And it's this type of transitional look here, a rollover look, and this type of inflection point look that we covered on short takes this week. You can find a description of these charts by Googling this title here. When we flip in one session from a constructive look to a concerning look, it's that observable shift and deterioration that has us writing sentences like this on December 5th. Tuesday's big drop increases the odds of the S&P 500 taking a significant leg down. And in between this date here and this date here, the observable deterioration is why we're spending several hours on Thanksgiving Day checking, rechecking, and adjusting our exit strategy. I can assure you, if the facts that we have in hand on November 22nd, 2018 look extremely favorable and bullish, we are not going to be spending several hours on Thanksgiving Day. We're working on Thanksgiving Day because the data has deteriorated in a concerning manner. So let's talk a little bit about that in the context of our strategy. We just showed October 31st, things look pretty good. On October 19th, we're discussing a bear market scenario in generic terms. You don't write posts like this if you don't have data to support it. There's observable deterioration between this point and November 19th. And there's observable deterioration between November 19th and Thanksgiving Day. So if you're a client, a fair question might be, if you're seeing this deterioration, why aren't we doing more? Well, to answer that, let's look at the S&P 500 between October 10th and the present day, December 7th. We get a big drop, a big whipsaw, another head-snapping whipsaw, followed by a sharp rally in the other direction, only to see the market perform an about face again and move sharply in the opposite direction. And we know what's coming next. Another whipsaw to increase stress and anxiety for shorter-term traders. And if we fast forward to the present day, we get another sharp move in the opposite direction. While it may feel like a lot's been going on since October 10th, price has remained inside this box. This is a form of consolidation that's lasted roughly 2 months. How do we know that? We can draw our horizontal lines and hit price numerous times. And history tells us that this is not particularly surprising. So between October 31st and November 19th, when we're seeing observable deterioration, we're also acknowledging on November 12th in here that an attempt to form a bottom can produce whipsaw after whipsaw after whipsaw after whipsaw after whipsaw. And a sideways movement, not particularly surprising, bottoming process in 2016, bottoming process in 2011. And fractals tell us that no matter what the time frame, the longer we move sideways, the bigger the move we can expect to get, whether we get a bullish breakout or bearish breakdown. So we noted in the past, from an execution perspective, we're waiting for the market to tip its hand a little bit one way or another to try to avoid getting whipsawed out of our minds and dying a death of 1,000 cuts. And while markets always make us feel like we're out of control, if we take a step back, we can actually see that we're executing exactly according to the plan that we've laid out in recent weeks. This little blurb here appeared in a short takes post dated November 14th, 2018. When markets are indecisive, they can rally sharply for 5 days and then drop like a stone for 5 days. Last week, over a 5-day period, the S&P 500 was up 4.85%. This week, over a 5-day period, it dropped like a stone and was down 4.6%. Back to the November short takes post. If we continually try to allocate to data that is flipping like a flapjack, we would most likely destroy value rather than add value. Thus, we must seek a prudent balance between managing risk and managing the risk of overtrading, a concept that applies to mid-November 2018 and still applies as of Friday, December 7th, 2018. That blurb appeared in the November 14th short takes post with the title Whipsaws and Market Guideposts. But given what we know today, all the concerning things that we've talked about, if we break from the consolidation period, we know at least the odds increase that we could see another leg down. We also know from the 2011 case that you can break out or break down from the box, make a discernible lower low, and then have something change in the news cycle, and our concerning breakdown can turn into a false breakdown and be followed by big, big gains, which is why we always have to take it day by day and maintain a stance of maximum flexibility. Things can change very, very quickly when something changes in the news cycle. Some other reasons to try to be patient. Equity put-call ratio, won't go into the details here, but when it spikes high, it tells us there are concerns about more downside and more volatility. This spike here came near the February low. This is the S&P 500. It rallied. This similar spike here came at a recent low, and on December 6th, we saw a very, very similar level. Nothing says that the equity put-call ratio can't spike higher and the S&P can't move in this direction. Let's talk a little bit about the yield curve. We've covered this in a video in detail, so we'll move quickly. December 4th, 10-year treasuries minus 2-year treasuries. This part of the yield curve has not inverted yet. On December 4th, we're sitting at 0.11. On Friday, December 7th, we closed higher at 0.13. So we're still at a point relative to this part of the yield curve. The yield curve has not inverted. The yield curve is about to invert. To put the present day reading in some context, we also could have said the yield curve is about to invert on December 27th, 1994. The reading of 0.09 was actually lower than the reading that we had on both Tuesday and Friday of this week. The yield curve is about to invert is radically different from the yield curve has inverted. What happened after the yield curve was about to invert? From that exact same day, December 27th, 1994, we didn't go into some crazy recession or depression. The stock market didn't crash. The S&P 500 gained 230% from December 27th, 1994 until the peak on March 24th, 2000, helping us keep an open mind about all outcomes, especially from a longer-term perspective. The segment of the yield curve that we just covered really doesn't tell us anything about what's going to happen in the short term. It doesn't help us much with the probability of whether or not these lows are going to hold, but it does help us with the probability of entering a recession and/or a significant and serious bear market. Oh, wait a minute, you just said that the yield curve hasn't inverted. I saw several times this week that the yield curve has inverted. Yes, it's true. A different segment of the yield curve, the short-term end of the yield curve, has inverted. We don't even track the spread between 5-year and 3-year treasuries. Why? Not only is it not helpful, it can be harmful. RB Advisors, their Twitter handle here, did a handy little study. We've looked at this before as well years ago. What happened after previous short-term yield curve inversions? The answer is, in these cases here, the average return was 19%, and the next bear market didn't begin for 29 months. 29 months from this week, when we had short-term yield curve inversion, 29 months out into the future says our next bear market comes in 2021 if we follow the average path. You may see that 1973 is on this list, and a bear market had already begun, and we may be in one now. But if you know your history, you know there's a lot of stuff going on in the oil markets here with the oil embargo and some relatively rare circumstances relative to the other periods. So while this not particularly helpful and actually harmful if you use it as a bearish signal historically, in 1, 2, 3, 4, 5, 6 out of the 7 cases, this would have been a harmful signal rather than a helpful signal. That's not the type of signal that we want to use. This has inverted. The portion of the yield curve that we track that has been helpful has not inverted. It is close to inverting. Some other information about the not particularly helpful part, the spread between the 5-year and 3-year. From Twitter, quoting Tom Lee, we reviewed all points on the Treasury curve, and the least reliable spread is the spread between the 3-year and the 5-year, which is the portion of the curve that inverted this week. There have been 73 unique instances of yield curve inversion, if we're using the not particularly helpful 3-year and 5-year. In the past 64 years, out of those 73 inversions, only 9 recessions. A lot of head fakes and a lot of bad signals using the 3- and 5-year spread. And let's assume that the 2- and 10-year spread, the more helpful spread, inverts. History tells us that still doesn't necessarily mean disaster is around the next corner. After the first sign of inversion in 1998, the S&P 500 didn't peak for 668 calendar days. And this portion of the curve in the present day has not inverted yet. Similar situation here. The yield curve inverted in 2006. Did that mean we had to sprint for the exits? No, the S&P 500 peaked 651 days after the first sign of inversion using the 10 and 2-year. Using the 2 cases we just covered, the average number of days before the stock market peak was 660 calendar days. The average gain between the first sign of inversion, which we don't even have yet, and the major market peak, 32%. Therefore, hypothetically, if that portion of the yield curve inverted this week, and it has not inverted yet, but hypothetically if it did, the S&P hypothetically would peak on September 27th, 2020, at a level of 3561. The observable deterioration that we have in the hard evidence that took place from roughly the end of October to the present day tells us if the market breaks out of this box to the downside, it is prudent for us to begin stepping away in an incremental manner, which takes into account we could fall somewhere in the neighborhood of another 15%, or we could morph into something like this or this. And the reason why we have to take it day by day, in all of these historical cases, it felt horrible. We had red screens, we had horrible technicals, concerning fundamentals, and calls for a new bear market. And we know that in 10 of the actual 12 historical cases, because the 13 includes 2018, in 10 of those cases, something changed and the market rallied significantly, which is why our plan, as we described a few weeks ago, takes into account that we could see surprising gains or big losses from here. And if we add in the gains that occurred on average after the first sign of yield curve inversion with the 3 and 5 years, so the shorter end of the curve, that's even on average a 20% gain. The world doesn't end if these lows are taken out. They are simply reference points. There are plenty of cases here that we covered where the lows were taken out, something changed, and the market reversed sharply. Maximum flexibility. Don't want to be overly focused on the shortest of time frames. Our real concern out of an ugly chart pattern, 2007, out of an ugly chart pattern, 2016, is to get the longer term move right. What happened after this point A and this point A? In this case, really bad things happen for a long period of time, telling us having our focus on every tick in the present day could be a big, big mistake. And with a similar setup in 2016, really good things happened for a long period of time, which means it's important heading into next week and every week that we keep in mind these concepts outlined in this post. Take it day by day without getting overly excited about what's happening in the short run, and remain open to all outcomes, from wildly bullish to wildly bearish. Let's talk briefly about the death cross. To put some historical context around it, we have a secular bull market that runs for 18 years from 1982 to 2000. How many times did the 50-day drop below the 200-day? The answer is 8 times, telling us that a death cross viewed in isolation isn't necessarily a showstopper for the longer-term trends. From a MarketWatch article dated December 7th, 2018, 11:52 a.m. Eastern Time, Mark Hulbert looks at the history of Dow death crosses and draws this statistical conclusion. This is directly from the article. There has been no significant difference since 1970, that's a long time, between the stock market's average performance following death crosses and at all other times. This aligns perfectly with one of the major morals of the story from this analysis, where we looked at the 12 ugly historical chart patterns. How long will this death cross be relevant? The ugly looking chart is relevant until it doesn't look ugly anymore. And as of December 7th, 2018, it still looks ugly. But as these ugly historical cases show, that doesn't mean we can extrapolate the ugly charts and the concerning headlines indefinitely into the future. We'll continue to take it day by day and make decisions based on the facts in front of us. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.